The stock market is often seen as a fortress of financial stability, governed by the forces of supply and demand, corporate earnings, and economic policies. But in the modern world, where billions of trades are executed by algorithms at lightning speed, even the smallest mistake can unleash financial chaos. In fact, history has shown that sometimes all it takes is a single line of code to send the market into freefall. What follows is the story of one of the most infamous trading disasters in history, a technical glitch so small, yet so catastrophic that it shook Wall Street and sent shockwaves through the entire financial world. The rise of algorithmic trading. Before we get into how a mere line of code caused a multi-billion-dollar disaster, we need to understand how the stock market operates today. Decades ago, human traders manually executed trades, relying on their instincts, strategies, and the speed of their hands. But as technology advanced, financial institutions sought ways to make trading more efficient, precise, and most importantly, faster. Enter algorithmic trading, the use of computer programs to automatically execute trades based on preset conditions. These programs analyze market data, identify trends, and execute transactions in milliseconds far faster than any human ever could. By the early 2000s, algorithmic trading had taken over Wall Street. Hedge funds, banks, and trading firms developed highly sophisticated algorithms designed to take advantage of minute market fluctuations. These algorithms were trusted to handle billions of dollars in trades daily, and firms competed to develop the fastest and smartest trading bots to gain an edge in the market. But as these systems grew in complexity, so did their vulnerability. One small mistake in the code could set off a chain reaction that could spiral out of control before anyone even realized what was happening. Knight Capital, the $440 million mistake, one of the most shocking examples of how a single line of code can wreak havoc on the stock market, occurred on August 1, 2012, when Knight Capital, one of the largest trading firms on Wall Street, found itself at the center of an unprecedented financial disaster. The firm, which specialized in high-frequency trading, had recently rolled out a new software update designed to improve its trading strategies. However, unknown to its developers, a critical bug lay hidden within the code, one that would cost the firm its future. When the market opened on that fateful morning, Knight Capital's algorithm kicked in. Within milliseconds, the firm began buying and selling millions of shares at an uncontrollable rate. The problem? The software contained an outdated piece of code that mistakenly sent orders at 100 times the intended volume. In the blink of an eye, Knight Capital found itself executing thousands of trades per second, pouring billions of dollars into the market without any control over what was happening. A market in chaos at first. Traders on Wall Street were confused. Stocks that normally traded with minor fluctuations were suddenly skyrocketing or plummeting without explanation. Some shares surged 10% or more within minutes, while others crashed in value, all because of the faulty algorithm. Traders and analysts watched in horror as the market swung wildly, with Knight Capital at the epicenter of the turmoil. The company's software was buying high and selling low, hemorrhaging millions of dollars with each passing second. By the time the firm's engineers realized what was happening, the damage was already catastrophic. In just 45 minutes, Knight Capital had lost $440 million, a staggering amount that wiped out nearly all of the company's capital. The aftermath. A lesson in risk management. The aftermath of the Knight Capital disaster was brutal. The firm was left scrambling to contain the damage, but the financial world had already lost confidence in it. Within days, Knight Capital was forced to accept a rescue deal from a group of investors to stay afloat, but the damage to its reputation was irreversible. Just months later, the once dominant trading firm was acquired by a rival and ceased to exist as an independent company. The incident sent shockwaves through Wall Street, leading to widespread discussions about the dangers of algorithmic trading. Regulators and industry experts began questioning whether the relentless pursuit of speed and efficiency had made the stock market more fragile than ever before. If a single line of faulty code could bring a firm to its knees and disrupt the market in mere minutes, what other hidden risks lay beneath the surface? Other algorithmic trading disasters. The Knight Capital disaster wasn't the first or the last time a trading algorithm caused chaos. In fact, on May 6, 2010, Wall Street witnessed the infamous flash crash, where the stock market lost nearly $1 trillion in value within minutes before recovering. The cause? A poorly designed algorithm triggered a selling frenzy, which cascaded across the market at high speed, causing one of the most dramatic collapses in stock market history. Similarly, in 2013, a bug in the trading algorithms of a major firm mistakenly placed a flood of incorrect orders, leading to a sudden market drop. In both cases, automated trading systems moved so fast that human traders couldn't react in time, proving that while algorithms are incredibly powerful, they can also be incredibly dangerous if not carefully managed. The human cost of a single line of code. While it's easy to think of these incidents in terms of numbers, it's important to remember that real people suffered because of these failures. Thousands of retail investors saw their portfolios wiped out in seconds. Companies whose stocks were caught in the algorithmic chaos faced massive losses. Even experienced traders, who had spent decades in the market, found themselves powerless in the face of a runaway algorithm that cared nothing for logic or reason. For Knight Capital's employees, the disaster meant job losses, financial ruin, and shattered careers. The firm had been a powerhouse in the trading world, but a single line of faulty code was enough to bring it all crashing down. The event served as a harsh reminder that even in an industry driven by technology, human oversight is not just important, it's essential. Lessons learned. Can we prevent another trading meltdown? Since the Knight Capital debacle, regulators have introduced stricter risk controls, requiring firms to implement safeguards to prevent runaway algorithms from wreaking havoc on the market. Circuit breakers, automatic mechanisms that temporarily halt trading when extreme fluctuations occur, have been enhanced to prevent crashes from spiraling out of control. Firms are now required to conduct rigorous stress testing before deploying new trading software, ensuring that no hidden bugs can trigger a disaster. But despite these improvements, the risk remains. As long as markets rely on complex algorithms to execute trades, the possibility of another catastrophic failure lingers. The lesson of Knight Capital is clear. In the world of high-frequency trading, a single mistake, just one flawed line of code, can cost hundreds of millions of dollars, destroy a company, and shake the very foundations of the financial system. So, the next time you see the stock market fluctuate wildly in mere seconds, remember, behind those numbers, behind the screens, behind the trades executed in milliseconds, there might just be a single line of code deciding the fate of billions of dollars and perhaps the fate of an entire company.